It is the 20th of February 2021. My name is David Hickson, and in today's market update we're going to be taking a look at the S&P 500. The subject of today's market update is the 20-day FLD again. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. Why is the title of today's video the 20-day FLD? At the end of my previous market update, which was last week, I mentioned that the way that we would know what the magnitude of this trough at the beginning of February actually was would be by taking a look at the way in which price interacted with the 20-day FLD when it next came down to touch or interact with that FLD. And of course, that is exactly what happened this week. And so let's take a look at that interaction and consider what it tells us. First of all, you will remember that I presented two options in my previous market update video. The one option was that the trough at the beginning of February was the 40-day cycle and that the 20-week cycle still lay ahead of us. That is the option presented at the foot of this chart. The other option we'll take a look at in a moment. Now, if this turns out to be the correct analysis for the market at the moment, then as I mentioned, the interactions between price and the FLD, which follow a very reliable sequence over every 80-day cycle, would imply that we expected price to cross down below this FLD. And the reason for that is because our sequence of interactions would have been A, category interaction here, B, here, as price comes down into the 20-day cycle trough, C, category interaction as price heads back up and away from the FLD. Price found approximate support at the level of the FLD at this point. Here, the D category interaction where price crosses down below the FLD and reaches its target measured by calculating the distance up to the level of the FLD at the point at which it crossed it. Then an E category interaction where again price is expected to reach its target generated by measuring the distance from the low point to the level at which price crossed the FLD and projecting that upwards. I presented those targets in last week's video. You can see that price in fact didn't quite reach the target that we calculated. It very nearly reached it, which might be an indication that the bull that we are watching is beginning to weaken a little bit. But the important thing here is that according to this analysis, the next interaction would be an F category interaction as price crosses down below the 20-day FLD on its way down to this 20-week cycle trough, which is presented in this nest of lows at the foot of the chart. Now, an F category interaction usually gives us a good short trading opportunity, but you don't always jump into every potential F category interaction, particularly when you have an ambiguity in the analysis, which is exactly what we have here, because as mentioned in the previous market update video, there is another option. And so when you have two potential options, you don't simply blindly trade the interaction with the FLD. What you probably will do, unless you have very high confidence in one particular analysis, what you will usually do is you will watch the way in which price interacts with the FLD. As you can see, price came down to the FLD on Wednesday of this week and touched it and immediately bounced back up again. The FLD is a very extraordinary line. You will discover when you start working with it, and you will often see that when price reaches the FLD, it immediately shies away from it. That is exactly what happened on Wednesday. That seemed to indicate that price was finding support at the level of the FLD. The FLD very often provides what I call approximate support, which means that price tends to spend a little bit of time straddling the FLD. In other words, the high price of the day is above the FLD and the low price of the day is below the FLD. And so it wasn't a very big surprise to see that on Thursday price came back down to the FLD, reached a little bit lower and ended up the day just above the level of the FLD, thereby straddling that FLD. And price did the same thing on Friday. So what is happening here? Well, in my opinion, this does not look like a usual F category interaction. F category interactions are usually fairly swift and price moves quickly down through the FLD. This looks as if though price is finding support at the level of the FLD. And so my preferred analysis is definitely the other one that we will take a look at in a moment. However, this analysis is still possible, although in my opinion less likely. How could you now trade this possibility if you believe that the 20-week trough still lies ahead of us? Well, what you could do is if price drops down below the low of Thursday, then at that point you could enter the trade because you would still be expecting price to drop down into this 20-week cycle trough. But as I've mentioned, the current interaction with the FLD doesn't look very much like an F category interaction. You must remember that the way in which price interacts with the FLD is more of an art than a science. You will find instances of an F category interaction in which price struggles to get through the FLD. FLDs are very powerful lines, and price will sometimes struggle to get through the FLD even if it is currently in an F category interaction or in an A category interaction, which is the matching interaction, if you like, on the long side. So let's take a look at the other analysis and see what is happening there. In this analysis, you can see that I have now pinned the 20-week cycle trough as having formed at the beginning of February. In last week's video, it wasn't possible to actually pin it there because there wasn't enough price evidence after that date to confirm the placement of that trough, but now there is. And so this is the other analysis that we were looking at in our previous market update video, which phases the 20-week cycle trough here on the 1st of February. With the 20-week cycle trough over here, our interactions with the FLD are labeled differently. This is now the A category interaction, and what we would be expecting to form round about now is the B category interaction, which is where price finds support at the level of the FLD. And that is the important point. We are expecting price, if this is a B category interaction, which it would be if this was a 20-week cycle trough, we would expect price to find support at the level of the FLD. And as I have already mentioned, it certainly looks as if though price is finding support at the level of the FLD. This increases my confidence in this particular analysis. The B category interaction forms at around about the same time as the 20-day cycle trough forms. Now here is the nest of lows for the 20-day cycle trough. As you can see, it is a little bit messy and stretched out, but it is certainly possible that this is a trough of the 20-day cycle that is forming over here. If we measure the number of bars that have elapsed since the beginning of February, where that 20-week cycle trough formed, according to this analysis, there have been 17 days or bars, and in fact the average length of a 20-day cycle as found by Hurst way back in the 1970s was 17.1 days, and so that is a really likely candidate for a 20-day cycle trough, which means that we would expect price to find support at the level of this 20-day FLD. You will notice, however, that the recent average wavelength of the 20-day cycle has been very short. This is something I've discussed in previous market update videos, the fact that the cycles seem to be running fairly short, and the average length has been a little under 12 days, so 5 days shorter than usual. Now, a 12-day cycle or 11.9 day cycle would bring us in round about here, and so it is just possible that this is in fact where the 20-day cycle trough should be positioned, and we are now seeing the move down into the next 40-day cycle. However, again, the fact that price has found support so far at the level of this FLD increases the odds, in my opinion, that the 20-week cycle trough formed here at the beginning of February. What I would like to do now is take a big step back, because there has been a lot of talk in the media recently about whether we are in the very late stages of a bull or are we in an early bull. And of course, from a Hurst cycles perspective, the question of the magnitude of this trough in 2020 will to some extent determine that, because if that was a 54-month cycle trough, then we would probably be expecting price to turn around fairly soon in order to get down into the next 9-year cycle trough. But if this was a 9-year cycle trough in early 2020, then we are still in the early stages of a bullish market because of that 9-year cycle trough. And seeing as we are now considering a potential long trading opportunity if the 20-week cycle trough formed recently, one of the questions many people have is, how many more long trading opportunities will we have? So let's speak for a moment about the magnitude of this trough in early 2020. One of the tools that I like to use when considering the magnitude of the longer cycles are the cycle lines and the composite model lines. So if you will indulge me for a moment, I'm going to show you some of those. These are what are called cycle lines, which are the extracted information about the individual cycles. I very rarely show them in these market update videos because they can be a little complicated in terms of their interpretation, but you can see they present very beautiful sine-shaped cycles which have been extracted from the information held in this analysis. So for instance, this red line is the 9-year cycle line, and you can see it reaches a low point or a trough where the trough has been found in price, and it will reach another trough where the next trough of the 9-year cycle is expected. Similarly, this orange line is the 54-month cycle line. It is also forming a trough at the time of the 54-month cycle trough, and here it is forming another trough, and so forth. The interesting thing about these cycle lines is that they show us the influence that each cycle is having at the moment on the market. And of particular interest right now is the fact that the 54-month cycle is influencing price to move up. As you can see, it will stop influencing price to move up round about 2022, that looks like early 2022, and then it will influence price to move down. So the influence is in the direction of the movement of each one of these lines. What is interesting right now is that according to this analysis, which assumes that the trough in 2020 was only 54 months in magnitude, the 9-year cycle line is influencing price to move down. What is interesting about that is that price has been moving up very strongly. So where is the influence of the 9-year cycle? That brings into question the magnitude of this trough. So another way of visualizing the analysis that we have on our charts is, of course, the composite model line. And in the composite model line, we can select only certain cycles. So in this case, I've selected cycles from the 9-year cycle down to about the 20-week cycle. And you can see that the composite model line is not matching price very well. And in fact, the composite model line is indicating a series of lower peaks, which should be happening around about now, and that the highest peak should have been way back here in 2019, I think that is. So what is going on here? Well, let me show you something about the composite model line. You can choose to add different cycles into this line, and one of the cycles we can choose to include is what is called sigma L. I don't have time to explain it in detail in this video, but it is effectively the sum of all the cycles that are longer than the longest cycle found in this analysis. If I add that to the composite model line, it really changes the shape of that composite model line. So what does that mean? It means that there has been a very powerful influence on the markets, which is something longer than all the cycles that are included in this analysis, or something that isn't accounted for by the analysis. And that's a very important point. Now, in my opinion, the thing that is not accounted for is the fact that the 9-year cycle trough is in the wrong position. So let's take a look at another analysis where I have positioned the 9-year cycle trough in March of 2020. Here is that analysis, and you can see a 9-year cycle trough in March of 2020. Let's add the same cycle lines to this analysis so that we can see what those cycle lines are telling us. Here we can see that the 54-month cycle at the moment is influencing price to move upwards, and the 9-year cycle is also influencing price to move upwards at the moment. And so that makes a little more sense, I think you will agree, in terms of the bullish move that we have had since March of 2020. Which is why in these videos I will often mention the fact that I believe that the trough in March of 2020 is potentially of 9-year cycle magnitude. Let's add our other tool, the composite model line, and see what it says using this different analysis information. Here you can see that the composite model line seems to match the price movement a lot better than it did in the previous analysis. And the reason for that is because the cycle analysis is probably a better fit for what actually happened in the market. And it is for that reason that I think it very likely that the 9-year cycle trough probably formed in March of 2020, which is why we have seen so much bullishness recently. The broad strokes for the implications of this are that price will continue to rise, and so a short-term long trade now might not be inappropriate. But then, of course, we are going to see the market coming down into the next 18-month cycle trough, which is something that we are going to have to discuss soon. After that, price will continue to rise, and it will probably even reach a new high point before turning down and coming down into the next 54-month cycle trough, which is then expected towards the end of 2024, maybe early 2025. So that's a really long-term perspective on what's happening. I thought it might be interesting to take a look at a longer-term picture, because sometimes we can be so focused on that 20-day FLD and whether we're getting a long trading opportunity that we occasionally need to step back and just ask ourselves, where does our current long trading opportunity fit into the general market? If this is what is happening, then it would probably not be inappropriate to be entering into a long trade now. However, if the trough in 2020 was of only 54-month magnitude, and this is the correct analysis, and we ignore the sum of all the longer cycles or the unknown factors, then we certainly need to be on our toes. We will still have a move down into the 18-month cycle trough over here, and then a move down into the big 9-year cycle trough in 2024. But entering into a long trade now is something that we should approach with a little more caution. I do hope that you found this market update interesting. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.